Sure. As value investors, we'll go anywhere. We are industry agnostic as to where we want to make money. It's about that value gap. And really, as value investors, what we're really doing is arbitraging what is perception in the marketplace and what we think reality is, the value of a business, whereas perception is the price it's trading at the moment. What we try to do, our portfolio gap today is about 33%, and that's the weighted value of where we think the share prices should be in the next 2 to 3 years. What we do is just where we get that gap from is we go in looking for about a 40% gap over 2 to 3 years when we initially buy a company. A lot of people think that's very, very aggressive. So essentially, we're almost looking for 20% a year. Have we done 20% a year? No, I think in the US we've done, 12 and a half over the last 25 years. So people say, why have you only done 12 and a half? Well, the one thing we can tell you up here, you can say this too, we do make mistakes. And so that's why we have portfolios. We hold as well about 25 companies. But if you look at it, CRISP, that's from the University of Chicago, the Security Pricing Institute, they say 30% of a portfolio manager's decisions are mistakes. So if we're lucky, we don't lose any money on our mistakes. Basically, if you're looking at 40% over 2 to 3 years, you're looking at about a 13% return. So we like to work backwards. If we're going to produce superior rates of return to the index, we actually have to have a formula of how we're going to get there and make sure that the companies that we buy and when we buy them fit into that formula. That they've given us about an 8 to 10% distribution every year. Now, it's interesting, it's trading at $33 today. We think it's worth $55 for many reasons. And when we look at it, really what the market's valuing Blackstone at is really just today's fees, just what their regular management fees are. There's no value to the carry at all. Blackstone's also been growing. They've been raising a lot of money. They have a lot of what they'll call dry powder that hasn't been invested yet, so that's not earning fees. Eventually it will get invested as well. So when we look at it today, and if they just do what we would consider a mediocre job, not doing what they've done in the past with their private equity and real estate, but bring it down to about 12% rates of return, we think the company's worth $55 just looking at the fees that it will collect based on that. They're also growing. There are limits to growth, but they've been doing a great job. And the interesting thing, as I was mentioning as well, is there's another little catalyst in between. We've seen Donald Trump did tax reform in the US. So basically what that means to Blackstone, it's a limited partnership. It was a limited partnership because they were arbitraging corporate and individual tax rates. Stephen Schwarzman, who is the CEO of Blackstone, has mentioned that he is looking at moving it to a corporation. He's not guaranteed that, but he's looking at moving it to a corporation. So what does that mean? Well, Blackstone is a $40 billion limited partnership. It's not in any index. It's not allowed to be included in an index. If it becomes a corporation, it will become part of the index, and we think it could bump up 10 or 15% right away. That's not why we own it, but it's a nice catalyst to have.
Which is part of our index.
Stocks were legging into a company, and it's called Newell Brands. The brands they combine with a company called Jardine, but they make rubber garbage cans, but they're also Sharpie pens. There's a whole host of iconic brands that they own, and it wasn't well managed. We just started to get into it, then we found out Carl Icahn took a run at it the other day, and Starboard Value Investors, and they're replacing the board. So actually, I think we may have a fuller position because it went down. But it makes us feel a little more comfortable when we're buying something that is down about 45% from its high. It has a great brand portfolio, but a poorly managed business, a poorly done merger. We're starting to leg in, and we see other value activists get in trying to change the board. That's always a good sign. So in many cases, we don't think we need a monopoly on an idea. If we can hear an idea here, and then we do our own research and it works for us, that's great. We'll take it where we can get it. That I was taught about 25 or 30 years ago. If you remember in the old days, people, when you had to buy a stock, you'd have to write out a buy ticket. And an older portfolio manager taught me that if your hand's shaking when you're writing the ticket, it's a good buy.
Very much. So, yeah,
I should add just one thing. He mentioned Chapter 11's great source of new ideas, by the way.
if they come back.
If they come back,
Yes.
but when they're in the middle of it, usually no one wants to touch them. And we've had one called General Growth Properties, a U.S. shopping mall REIT, that went into Chapter 11. We were able to buy it very cheaply, and it's done very, very well for us. So they sometimes they're a great source of buying after the Chapter 11. No, I think that the repercussions of the credit crunch still come home to roost. The major banks, the ones that are too big to fail in the States, still have higher capital. And when you look at the Basel Accord, just being up the road, they're adhering to that for the first time ever in the States. I shouldn't say first time ever, but they're really hoarding capital. So what's really gone on in the US markets is the larger banks are only lending to the highest credit quality companies. In fact, there is a little bit of a problem. It's a bifurcated or two-tiered market in the States for lending. If I need money and I can't get it from a bigger bank, I have to go to a smaller place and pay an enormous amount more than the going rate just to get it. And so I think that, it's actually almost a different problem in the States. You've seen not as much loan growth to smaller businesses. And one of the things that you were talking about is they pump the money supply. But I remember going back and learning in economics, what it really meant was a velocity of money, how often that money turns over. It's called V2 in the States. I haven't looked at it in maybe a year, but it was at its lowest level. And so I think that the big thing with the economic recovery is as that starts to recover, that's actually a good thing. Will we get into some sort of credit bubble again at one point? I don't want to call it a bubble, but yes, but we're not there yet. But absolutely.